Hi, it's Michelle Costin here. I'm going to debrief you on problem 18-6 on page 1152. I certainly hope you've really tried to do this yourself before looking at this video. Our task right now is to calculate the taxable income for Stephen Corp. And we're going to walk through the question step by step the way you would have worked it out yourself. I've set it up in Excel just because it'll be easier for you to follow. You certainly can do this by hand. I guess one of the things I'd want to tell you is to leave yourself some blank spaces so that you can be flexible in your calculations. And I want to remind you that these calculations, of course, are working papers and that the final answer is, well, the final answer. So let's start at the beginning, and it tells us that it's a December 31st year end, and I've labeled the columns appropriately, and that they have income before tax of $850,000 in the first year and $525,000 in the second year. They also give us the following information, and the first thing they tell us is that the Stephen Corp pays an annual life insurance premium of $11,000, that this covers the top management team. Life insurance premiums are never deductible under these conditions because the income from life insurance is not taxable. So it's a permanent difference. The second part talks about the carrying amount of the company's property, plant, and equipment. We're going to need that information when we calculate the deferred tax, when we set up that schedule. Right now, what we're interested in, though, is the expenses. And we can see that they recorded depreciation, and we know that depreciation is not allowed as a deduction for tax purposes. So we're going to have to add those amounts back in to income. Oops. But instead of depreciation, you remember that we're allowed capital cost allowance. And it does tell us that the capital cost allowance for tax purposes was $192,000 and $163,500 in 2018. The third part of the question tells us that they deducted $211,000 as a restructuring charge in determining income in 2016. Well, we're doing 2017 and 2018. They're telling us, though, that there was an accrued liability of $199,500 at the end of the year. And again, we're going to need that information when we calculate the deferred tax, when we set up that schedule. But right now, I want you to think about what happened. They incurred some actual restructuring costs in 2016, but they further debited the restructuring expense account and credited a liability account, so that at the end of 2016, there was an accrued liability of $199,500. The question tells us restructuring costs are deductible for tax purposes, but only as the actual costs are incurred and paid for. So that means that liability that was expensed in 2016 can't be expensed in that year. Instead, as the actual costs are incurred, that's when we're going to deduct the expenses. So the only trick left now is to figure out how much was the actual expense in 2017. Well, it tells us the liability was $199,500 at the end of 2016, and it's been reduced to $68,000 by the end of 2017. That then represents the amount of the actual expenses. The journal entry would have been a credit to cash for the actual expense and a debit to the liability account. But for tax purposes, we are allowed to deduct this. So we calculate the amount of actual restructuring costs that were incurred in 2017, and we deduct it. By the end of 2018, it's gone to zero. so we know that the remaining amount can be deducted as an expense for tax purposes. The next part of the question talks about the gain on the sale of land, the profits made from selling land, and it gives us some other information. It says that the sale was made on a delayed payment terms. It tells us the tax rules around it. It says that it's only taxable as the corporation receives payment. So that tells us that the $52,000 that was included in income in 2017 is not taxable. It's not included in taxable income, except to the extent that it was received. And it tells us that 10% was received. So we'll simply put 10% in here. The 90% then that's remaining is going to be received 1/3 each year over 3 years. So we're going to include 1/3 of the remaining amount in 2018. And then $15,600 will be included in 2019 and 2020 respectively. We don't care about those amounts right now. This is the amount that we include in 2018. The next part of the question tells us that Stephen Corp received non-taxable dividends. Well, it says right there that they're non-taxable, so we know that they are a permanent difference. And the amounts were given to you, $32.50. Remember, it was included in income. So now we're going to reduce the amount of income that is taxable. These amounts were already included in this amount, and so we're reducing it. Now, it also tells us that there was income before income tax of discontinued operations. So in addition to the income before income tax identified above, so in addition to these amounts, we have $18,800 that we now have to adjust our income before tax. This was presented this way for a purpose. You see that I have a little subtotal in here because it really is just an adjustment to the income before tax. We've gone through all the steps right now, and so you can see that we have calculated taxable income, and that's these amounts right here. I hope that helped to clarify some of the steps and just to give you some feeling of how to approach these questions. Thanks for your attention.